Now let's get into the rest of our discussion, and that's what role consumer and retail can play for investors in a weak market. We bring this up now because yesterday, the S&P, Dow, NASDAQ, they each declined 2%, 3%. All three indices are down significantly from their highs reached earlier this year. And volatility has been kind of the name of the game for a few weeks now. Asit and I talked about what's driving some of this volatility 2 weeks ago, but that doesn't necessarily make it any easier to sift through all these headlines, these predictions that you see that the next bear market, it's coming, it's on its way. So as this bear sentiment grows, we're seeing certain names in consumer and retail outperform. And specifically, we're talking about consumer staples and the value that they can have in your portfolio as a source of stability and diversification, especially when you're hoping to play defense without panicking and selling out of all your positions. I remember back in Econ 101, my professor, he discussed certain sectors of the economy, concepts like inelasticity of demand. Asit, can you break down consumer staples for us and the appeal that they can have in down markets?
Absolutely. So consumer staples are pretty much what they sound like. They are the staples that you buy every day that exist in your household. We're going to talk a little bit in this show about Procter & Gamble, but they give you maybe the easiest way to think of consumer staples. They have everything from tied to food products, packaged food products that they own and that consumers buy. So consumer staples, the things that you buy before the layer of your income that we call discretionary income. I'm going to just really briefly mention discretionary consumer stocks as a group as well. We'll touch on that during this show. Discretionary income is also just what it sounds like. It's the money that you can afford to use for the things that are treating yourself in life, maybe going out to eat or buying stuff from Amazon.com. Amazon is thought of as a discretionary stock. So these are sort of the two poles of consumer stocks. I should say these are the traditional ways to think of consumer stocks. On this show, of course, we talked a few months ago in our future episode about how the line between tech and consumer stocks is really becoming vague, and some stocks, which we now classify as consumer stocks, might as well be tech companies. But we're going back to bedrock definitions today. I'll flip it back to you, Vince, so we can dive into the rest of the tickers that we have for folks today. Well,
yeah, a big thing that I want to just cover to start things off and to offer some perspective as to why this sector, these consumer staples, these names, this part of the economy can be very powerful during times when things are uncertain, people are more bearish in the market, is the performance of certain, proxies. So Asit, one that you turned me on to before the show, the Consumer Staples ETF, specifically this one, the ticker is XLP. You look at it as a proxy for this part or this subsector, and you only have to look at the past month to see how its trading has diverged from the broad market. So since the big sell-off in mid-October, XLP is up almost 9%, while the S&P 500 is flat over the same period. And that extends, that outperformance also shows through year to date and in more recent months. You shared a chart with me, Asit. How did those numbers pan out?
Let's start with the year-to-date numbers, and this is from Fidelity. You can also find this if you go to the S&P website and look at their sector funds. But Fidelity's numbers show that year-to-date, the healthcare sector has the largest gain. It's gained 11%, followed by consumer discretionary, which is up 8%. I'm rounding here. Information technology is next. And then utilities. So information technology up about 7%, utilities up 4%. But everyone who's followed the market understands that conditions have really deteriorated over the last 3 to 6 months. So I'm going to now read you a 3-month view of market sector leaders. The first is consumer staples. That's up 6% in a 3-month period. Utilities are up 3.5%. Healthcare is up only 2%. And real estate is up less than 1%. Every other sector, from communication services to financials to information technology to energy, they're all negative over the last 3-month period.
Yeah, and I'll also give you a more historical look. Take 2008. and the lead up to the financial crisis. That was a year when S&P 500 shed just under 40%. A huge scare for investors across the market. But the XLP, as an example, during that time, took a hit of just 17% that year. It's not hard to see how having part of your portfolio invested in consumer staples during that time could have softened the blow from the rest of the market as things were selling off. So I took a look at the fact sheet for XLP and the top industries represented in it. Again, these are the things that arguably, you can't go without. That's the main theme for some of these industries. Think about food and beverages, household products, tobacco also traditionally included in this category as well. And among the top 10 holdings for XLP, you have companies like Procter & Gamble, which we mentioned, Coca-Cola, Walmart, Costco, Altria, among others. So these are supposed to be the companies that remain stable even in these weaker market or economic conditions because people need what they sell regardless of those conditions.